You've probably heard someone say, just buy Bitcoin and sleep well at night. But what if that advice is only half the story? Today we're cracking open one of the most misunderstood debates in crypto. Are blue chip coins actually safer, or are they just a different flavor of chaos? Let's set the stage. Bitcoin dropped over 70% in 2022, and Ethereum wasn't far behind, shedding roughly 80% from its all-time high. Meanwhile, some DeFi yield farms were printing 30, 50, even 100% APY right before they imploded and took everything with them. Think of blue chip crypto like a roller coaster at a well-known theme park. It's terrifying, sure, but the ride is inspected, the brand is established, and you know where the exit is. DeFi yield farming is more like strapping yourself to a rocket someone built in their garage, promising the moon and occasionally delivering exactly that before blowing up on the launch pad. The catalyst for this whole conversation is the maturation of crypto as an asset class, where institutional money started flooding into Bitcoin and Ethereum, while retail traders chased yields in protocols they couldn't even pronounce. Macroeconomically, rising interest rates crushed speculative appetite everywhere, but DeFi got hit twice, once from the market and once from the structural fragility baked into its own smart contracts. There was a moment, call it the euphoria window of 2020 and 2021, when DeFi felt like it had permanently rewritten the rules of finance and the headlines were intoxicating. Then came the hacks, the rug pulls, the algorithmic stablecoin collapses, and suddenly that optimism had the shelf life of milk left in the sun. Psychologically, holding Bitcoin through a drawdown feels different than watching a yield farm's token go to zero. One tests your patience, the other tests your sanity. Experts like Lynn Alden have argued that Bitcoin's volatility is the price of admission, while skeptics of DeFi protocols point out that complexity without audits isn't innovation, it's a liability. Here's the historical pattern nobody wants to admit. Every cycle, a new wave of high-yield opportunities emerges, attracts capital, collapses spectacularly, and then people act shocked, as if this hasn't happened in tech stocks, in junk bonds, in every speculative era before crypto existed. The 90s had its dot-com darlings, and we have our yield aggregators, different decade, same human psychology. Blue chip crypto fits into the broader boom-bust speculative cycle as the survivor asset, the thing that gets beaten up but doesn't disappear, while the community consistently returns to the thesis that scarcity and decentralization have long-term value. The DeFi community counters with real yield narratives, protocol revenue, and governance tokens. And honestly, some of that wisdom holds water if you know how to read a treasury balance sheet. One big misconception is that Bitcoin is safe in any traditional sense. It is not a savings account, it is not FDIC insured, and it can lose half its value in 90 days without a single fundamental changing. The real distinction isn't safe versus risky, it's auditable risk versus opaque risk. And understanding that difference is what separates investors from gamblers. Practically speaking, history rewards those who size their positions to survive the worst case scenario, not those who bet everything on the best case one. If you're allocating to DeFi, treat it like venture capital. Small position, high risk tolerance, and zero emotional attachment to the outcome. Discipline here means defining your allocation before you enter, not after you're already watching the price, because once dopamine enters the chat, strategy leaves the building. Process over conviction. Dollar cost averaging into Bitcoin or Ethereum across 12 to 24 months has outperformed most active DeFi strategies when you account for the losses people never talk about in their highlight reels. The philosophical truth is that in markets, crypto or otherwise, the person who survives long enough to be right eventually wins, and surviving requires sizing, patience, and an almost boring consistency. Blue chip or DeFi, the real risk isn't the asset, it's you making a panic decision at 3 in the morning because a Discord influencer told you the bottom was in. Here's the uncomfortable irony. The safer blue chip route still requires you to stomach soul-crushing volatility, while the riskier DeFi route occasionally produces life-changing returns, which means neither path is wrong, they're just differently brutal. Being comfortable with either outcome isn't weakness, it's the most rational thing you can do in a market designed to test your emotional limits. Whatever you decide, the framework is the same. Define your risk, size accordingly, stick to the process, And don't let a bull market make you feel like a genius or a bear market make you feel like a failure. The asset class is young, the rules are still being written, and the investors who will win are the ones building habits right now that compound over the next decade. And if you're looking to put your financial strategy on even more solid ground beyond crypto, whether that's real estate investing, home contracting projects, or finding the right lenders to build wealth, check out our links in the description below and let's help you get started.